Remember when getting 8% interest on your crypto felt like a sure thing? Welcome to the world of BlockFi, the company that promised to be the safe, reliable bank for the new digital age. They were one of the biggest names in crypto lending, managing billions in assets. Today, we're diving deep into the spectacular rise and devastating fall of BlockFi, a story of high-yield promises, hidden risks, and a fatal dependency that brought the entire empire crumbling down. How did a company that looked so solid just a few years ago end up in bankruptcy, leaving its customers high and dry? Let's unravel the story. So, what exactly was BlockFi? Imagine a bank, but for cryptocurrency. You could deposit your Bitcoin or Ethereum, and instead of earning a measly 0.1% like a traditional savings account, BlockFi promised you returns of up to 9% or even more. On the other side, people and institutions could borrow crypto from BlockFi, paying interest for the privilege. It was a simple, genius idea on the surface. BlockFi positioned itself as the grown-up in the room, the regulated, UC-based company you could trust in the Wild West of crypto. They attracted a ton of users, from seasoned crypto veterans to complete beginners who just wanted a better return on their savings. At its peak, BlockFi was a titan, managing over $15 billion in assets and serving hundreds of thousands of clients worldwide. They were the face of a new, accessible form of crypto finance. The magic word that drew everyone in was yield. BlockFi's high-yield interest accounts were their star product. How did they generate these incredible returns? Well, they weren't just letting the crypto sit there. They were actively lending it out to other players in the market, mainly large institutional borrowers like hedge funds and trading firms. These firms use the borrowed crypto for complex trading strategies like arbitrage, where they'd try to profit from small price differences across different exchanges. They were willing to pay a high price to borrow, and BlockFi passed a portion of that profit back to its retail customers. The problem? This model exposed BlockFi, and by extension its users, to massive counterparty risk. If one of their big borrowers couldn't pay them back, the whole system would be in trouble. For a long time, the market was booming and everything seemed fine. The money kept flowing, the interest kept getting paid, and everyone was happy. But under the surface, a web of dependencies was being woven, and one of the most critical threads led directly to another crypto giant, FTX. The crypto world is a small, interconnected place. It turns out that a huge portion of BlockFi's business was tied to Sam Bankman-Fried's crypto empire, which included the exchange FTX and the trading firm Alameda Research. BlockFi had lent a significant amount of its customers' assets to Alameda. This wasn't just a simple client relationship. It was a deep financial dependency. When other major crypto lenders like Celsius and Voyager collapsed earlier in 2022 after the Terra Luna crash, BlockFi was also hit hard. They had exposure to a failing hedge fund called Three Arrows Capital. It looked like BlockFi might go under right then and there. But who swooped in to save the day? None other than FTX. SBF offered BlockFi a $400 million line of credit, which essentially kept them afloat. While it looked like a rescue, it was more like a takeover. This deal gave FTX an option to buy BlockFi outright and tightened the leash even further. BlockFi wasn't just doing business with FTX anymore. Its very survival now depended on it. This deep reliance on FTX became BlockFi's death sentence. In early November 2022, the bombshell dropped. FTX was insolvent. A report revealed that Alameda Research's balance sheet was propped up by FTX's own token. Panic ensued. A bank run started on FTX, and within days, the multi-billion-dollar exchange collapsed, revealing a massive hole in its finances. For BlockFi, this was a catastrophe. They publicly admitted they had significant exposure to FTX and Alameda. This included assets they had on the FTX platform that were now stuck, and loans to Alameda that would never be paid back. The lifeline that had saved them just months earlier had now become an anchor, dragging them down to the abyss. The market's confidence in BlockFi evaporated overnight. If FTX, the supposed savior and industry leader, was a house of cards, what did that say about a company that was so deeply entangled with it? The answer was not good. On November 11, 2022, just days after FTX halted its own withdrawals, BlockFi did the same. They slammed the gates shut, freezing all customer accounts. For hundreds of thousands of people, their life savings, their Bitcoin they'd held for years, their dreams of financial freedom, it was all suddenly locked away, inaccessible. The company tweeted that they were pausing client withdrawals due to the lack of clarity on the status of FTX. The trust that BlockFi had spent years building was shattered in an instant. This is the moment every crypto investor fears. You log into your account and you can't access your own money. The panic, the anger, and the despair among BlockFi's customers were immense. They were left in the dark, with no idea if they would ever see their funds again. The platform that was supposed to be the safe gateway to crypto finance had become a digital prison for their assets. The final nail in the coffin came on November 28, 2022. BlockFi and its 8 affiliates officially filed for Chapter 11 bankruptcy protection. Court filings revealed the shocking extent of the damage. They owed money to over 100,000 creditors. Their single largest creditor was Ankara Trust, representing their interest account holders with a claim of a staggering $729 million. And who was their second largest creditor? FTX, with a claim of $275 million. It was a tangled mess. The bankruptcy process meant that the company would be restructured and a plan would be made to try and pay back creditors. But for customers, this was cold comfort. Bankruptcy proceedings are notoriously slow and complex. It became clear that even if they got some of their money back, it would likely be years away, and it would only be a fraction of what they originally deposited. The dream of high-yield, low-risk crypto banking was officially dead. So, what can we learn from this colossal failure? The BlockFi collapse offers some brutal but essential lessons. First, the age-old wisdom. If it sounds too good to be true, it probably is. 8% yield in a zero-interest world doesn't come from magic. It comes from risk. BlockFi was taking enormous, concentrated risks with customer funds, and they weren't transparent about it. Second, the phrase "not your keys, not your coins" has never been more relevant. When you give your crypto to a centralized platform like BlockFi, you are giving up control. You are trusting them completely, and as we saw, that trust can be broken. The bankruptcy process treats you as an unsecured creditor, putting you at the back of the line. Finally, the story highlights the danger of contagion in a highly interconnected and under-regulated market. One company's failure can trigger a catastrophic domino effect, wiping out others that seem completely healthy on the surface. The fall of BlockFi wasn't just a single event. It was a symptom of a systemic problem within the industry. It's a painful reminder that in the world of crypto, You have to do your own research, understand the risks, and never, ever invest more than you can afford to lose. Thanks for watching this deep dive into the collapse of BlockFi. It's a tough story, but one we all need to understand. If you found this breakdown helpful, please hit that like button and subscribe for more content on the stories shaping the world of finance and tech. Let me know your thoughts in the comments below. Were you affected by BlockFi, and what lessons did you take away from it? Stay safe out there, and I'll see you in the next video.